When you trace the history of business, the concept of the bank has almost always been defined by mass, like physical, unmovable mass.
Right, yeah, like a literal building.
Exactly. Even today, in the minds of a lot of founders, there is this lingering expectation of heaviness. You picture a vault, you know?
Oh, totally.
Yeah.
You imagine uh, Italian marble floors and these thick steel doors on time locks.
Yeah, and a very serious person in a tailored suit stamping a triplicate piece of paper. And historically, that heaviness, that was the feature, not the bug.
Right, it signaled security,
Exactly. It told you your capital is safe because we are this impenetrable fortress.
which, I mean, the architecture itself was the marketing. The
Yeah.
fortress was designed to be static.
Yeah.
It's a structure meant to sit there, absorb capital, and
Yeah.
just hold it securely against physical and economic threats.
Yeah.
And for centuries, that was enough.
But then you step into the reality of modern entrepreneurship. Suddenly, that fortress isn't a comfort, it's a massive
It's a
bottleneck.
huge drag on speed, yeah.
Because you don't need a vault to just sit there and look pretty while holding your cash. You need a highly kinetic operating system that actually talks to the rest of your digital business.
Right, because if your financial infrastructure feels like a 19th century vault, but your business is, a 21st century software company,
Or an agile e-commerce brand operating across 3 continents.
exactly, you are going to experience a crippling amount of operational friction.
It is the absolute definition of operational friction. And you end up with a highly agile company chained to a highly rigid financial monolith.
Which is painful. And the symptoms of that friction, they're everywhere in legacy business.
Oh, I've lived it. It's the founder waiting 3 days for a wire transfer to clear.
Or the accounting team spending 40 hours at the end of the month
Yeah.
manually reconciling paper receipts against a static PDF bank statement.
Just a nightmare.
The legacy bank basically sees its job as ending the moment the money is deposited.
Right.
But the modern business needs the financial platform's job to begin the moment the money is deposited.
Yes, exactly. And that fundamental tension is exactly what our deep dive is about today. We are looking at this critical pain point for growing businesses.
And we are going to explore a specific financial platform that was engineered from the ground up to completely eliminate that friction.
The platform is called Mercury. We've compiled a massive stack of source materials for this. Review documents, their official API documentation, user case studies.
And deep dives into their ecosystem, yeah.
Right. So our mission today is to unpack exactly how this platform works under the hood, who it is actually built for, and how it essentially acts as the financial operating system for modern business.
And, crucially, we're also going to dissect a very specific financial incentive they're offering right now.
Oh, yes. The cash on the table.
Because navigating the transition from a legacy bank to a modern fintech platform is a big behavioral shift, and they are subsidizing that shift with actual capital.
Exactly. And before we even get into the weeds of the software architecture, I want to address you, the listener, directly. We are going to be talking about a specific $250 referral bonus today.
A very specific one, yeah.
Right. Now, to get that bonus, you absolutely must use the special Datey Minds referral link provided in the description of this deep dive.
That's critical.
If you hear something you like today and you just open a new tab and search for Mercury on your own, you void the offer entirely. Consider the link in the description your VIP pass to do $250.
Don't miss out on free money just by opening a new tab.
Exactly. Keep that in mind as we go. Okay, let's unpack this, starting with the most foundational point that genuinely confused me when I first started reading the documentation. Mercury isn't actually a bank.
That is correct. And it is a fundamental distinction that trips up a lot of founders.
It tripped me up.
But understanding it is key to understanding modern financial technology. Mercury is a financial technology company. They are a fintech.
Okay.
They are a software layer. They do not hold a federal banking charter themselves.
See, that immediately makes me nervous. I mean, if I'm a founder and I'm depositing $3 million of Series of venture capital, and you tell me the company whose logo is on the app isn't a bank, where is the money going?
It's a fair question.
Are they just holding it in a giant digital wallet on an Amazon Web Services server somewhere?
Not at all. And what's fascinating here is how the architecture of modern banking as a service actually operates.
Banking as a service.
Or BI. It is an elegant division of labor. Mercury acts as the technology layer. They build the user interface, the API integrations, the automations.
The mobile app.
Right, the mobile app, the corporate card management system.
Yeah.
But the actual banking services, The literal holding of your deposits and the movement of funds through the Federal Reserve System,
Mm-hmm.
those are provided by their partner banks.
Oh, I see.
Specifically, institutions like Choice Financial Group and Column NA, which are fully chartered, heavily regulated, members FDIC.
Okay, I have to push back on the premise here. If Choice Financial Group is the actual bank holding the money, what is the point of the middleman? I mean, why am I paying? Or rather, why am I routing my business through Mercury? Why not just go straight to Choice Financial Group or Column NA, open an account, and cut out the software middleman entirely?
Because the middleman in this scenario is actually the product you are after. It comes down to the economics of specialization.
How do you mean?
Banks, true. Chartered banks are exceptionally good at being banks. They are highly regulated, heavily capitalized institutions designed to manage macroeconomic risk.
Right, they ensure compliance with federal laws, safely hold deposits.
Exactly. But that exact regulatory burden, that massive compliance overhead, makes it nearly impossible for them to also be cutting-edge, agile software development companies.
Their DNA is risk mitigation, not user experience.
Precisely. By splitting the responsibilities, you get the best of both worlds.
So it's a symbiotic relationship. The partner banks handle the regulatory heavy lifting. They handle the FDIC insurance.
Which means your eligible deposits are protected up to the federal limits in the event of a bank failure.
Right. And because they handle that, Mercury doesn't have to spend $1 billion a year on regulatory compliance infrastructure.
They can focus 100% of their engineering energy on building a lightning-fast, highly automated, deeply integrated software experience.
That makes a lot of sense. You are interacting exclusively with the software layer, but your funds are resting securely in the regulated banking layer.
And through sweep networks, which is a whole other fascinating topic where they can spread your deposits across multiple partner banks, they could actually offer FDIC insurance on amounts far exceeding the standard $250,000 limit.
Wow, really?
Yeah, up to $5 million in some cases. But the core concept is that you are buying Mercury's software, which just happens to be plugged directly into the federal banking system.
It's like the difference between the engine of a car and the dashboard.
Okay, I like that.
If you just buy the engine, the partner bank, you have combustion, power, and regulated mechanics, but you have no steering wheel.
Right, you can't actually drive it without burning your hands.
Exactly. Mercury is the digital dashboard, the navigation system, and the steering wheel that actually makes the power of the banking engine usable for a human being.
Well, the dashboard analogy is close, but it misses one crucial element, which is agency.
Agency.
A dashboard just displays information. Mercury's software layer actually executes commands automatically based on the data it receives.
Oh, so it's more like an autonomous driving system than just a dashboard?
Exactly.
Yeah.
But the fundamental separation of power and interface remains true.
Okay, before we dive into how that autonomous driving system actually works for accounting and billing, let's talk about the literal cash on the table that brought a lot of folks here, the $250 bonus.
Yes, the sign-up incentive.
Because honestly, anytime a financial institution offers free money, my skepticism spikes. There are always hoops to jump through. Let's clearly outline the steps to earn this $250 bonus because I want to make sure we demystify the fine print for you.
Absolutely. The mechanics of these referral offers are precise. They're automated triggers on the back end of Mercury systems.
Meaning if you miss a step, the computer just says no.
Exactly. Missing a single step means the API doesn't fire and you don't get the payout.
Step 1, and I will be the annoying friend who reminds you of this constantly, you must use the Daddy Minds referral link in the description.
Do not bypass it.
Right. That link contains the specific tracking code that flags your application for the bonus.
Step 2 is equally critical for the automated approval. You must be a net new Mercury customer.
Net new. Meaning, what exactly? If I had a personal account with them 3 years ago, or if I run 2 different LLCs and I already use Mercury for one of them, can I spin up a new account for the second LLC and grab the bonus?
No. That is exactly what net new prevents.
Oh, okay.
You cannot have any prior personal or business accounts associated with their primary identity or your primary business entities. You have to be entirely alien to the Mercury ecosystem prior to clicking that link.
Completely fresh. Got it. And I'll just say it again, make sure you use the link in the description when you do this. Okay, so if you pass that identity check, step 3 is straightforward, right?
Yes, you open an eligible business account through that specific link.
And then comes the big hurdle. Step 4. You have to deposit a minimum of $10,000 into this newly minted account within the first 90 days.
Which leads directly into step 5, the anti-gaming clause.
Let me guess. You can't just wire $10,000 in at 9 a.m. and wire it back out to your old bank at 2 p.m. just to trip the system wire.
Exactly. You must maintain that $10,000 balance for the required time frame.
And what is that time frame?
According to the terms in our source stack, that generally means maintaining the balance for at least one full business or calendar day.
Just one day.
Usually, yes. Though, as an aside, you always want to check the specific current terms at the time of your application because these things can update.
And again, to even see those terms, you need to click the link in the description. All right, so then step 6, the payout mechanics. The documentation states that payouts generally hit the Monday after the requirements are met.
Or Tuesday if Monday is a federal holiday.
Right, and they post within 1 to 3 business days. So if I can summarize the chronological flow for you, click the link in the description, be totally unknown to Mercury, open the account.
Deposit $10,000 within a 90-day window.
Let it sit there to satisfy the holding period. Get the $250.
It is a highly specific sequence driven entirely by code.
Right. When the balance hits $10,000 and the timestamp clears the holding period, the system automatically queues the $250 credit. And just a friendly reminder, since we're deep in the steps here, that link in the description is step 1. Don't skip it.
It's the key to the whole process.
Okay, but I have to play devil's advocate here, because if I'm a founder listening to this, I'm doing the math. A $250 payout on a $10,000 deposit is, what, a 2.5% return?
Rough math, yes.
That's nice, sure. But if I'm a bootstrap startup, cash flow is literally oxygen. Tying up 10 grand in a brand new, unproven to me platform just for a tiny bonus sounds like a massive opportunity cost.
I hear that a lot.
I mean, moving $10,000 around just to chase what is essentially pocket change for a business sounds like a distraction, if not a potential cash flow trap. Is this actually worth it?
That is a very valid critique if you are looking at this purely through the lens of investment yield.
Well, how else should I look at it?
If you're viewing the $10,000 as an investment to yield $250, then yes, the opportunity cost of that liquidity might seem high. But that is the wrong mental framework. This raises an important question about how banks calculate customer acquisition costs.
Or a CAC, right.
Yeah.
Expand on that, because 10 grand is payroll for 2 junior developers for a month.
Exactly. What's fascinating here is the strategy behind the incentive. Mercury's not trying to pay you an investment yield. They know their lifetime value of a good business customer is massive.
Right, if you stay for years.
They are willing to spend $250 in customer acquisition cost to get you to switch platforms. But from the founder's perspective, the ideal scenario is a business that already has $10,000 earmarked in their legacy bank for operational deployment.
Like upcoming payroll or a quarterly tax payment.
Or a scheduled inventory purchase from a supplier.
Yeah.
Precisely.
So you aren't scraping together your last 10 pennies to hit a threshold.
Not at all. If you are a healthy operating business, you likely have $10,000 in working capital right now. If you have recognized the friction in your legacy bank and you want the software automations Mercury provides, you simply make Mercury your new primary operating account.
Oh, I get it. You move that working capital over to capitalize the new account.
Exactly. The $250 bonus isn't a yield. It's a welcome gift for doing something you needed to do anyway, upgrading your financial stack.
It is an incentive to move your existing operational liquidity, not a reason to artificially drain your primary cash reserves to the point of structural danger.
Right. It aligns with your natural cash flow. It shouldn't disrupt it.
Okay, that reframes it completely. So if you just closed a seed funding round of $500,000, or you have consistent monthly recurring revenue of $40,000, parking 10 grand in the new account to establish your new financial hub is just a basic operational move.
Exactly. You literally get paid to set up the software that's going to save you time.
So let's assume you, the listener, have navigated the referral process. You used the link in the description, which again is right down there. You funded the $10,000 and you got the $250 bonus.
Step 1 complete.
Right. Now we actually have to use the platform. We are transitioning from the acquisition of the account to its daily utility. And the sources point out that traditional banking requires what they call patchwork operations.
Yes, the fragmented financial stack.
Mm-hmm.
This is the root cause of the friction we discussed in the introduction.
Right. Let's map out the nightmare that is the patchwork stack.
Okay.
You have your traditional bank, the vault, to hold the money, but the vault doesn't know how to send an invoice.
No, it just holds cash.
So you subscribe to a separate sauce tool just to create and send invoices to your clients?
But that invoicing tool doesn't issue credit cards.
Exactly. So you go to a different company, maybe an old school corporate card issuer, to get physical cards for your team.
And none of these systems speak the same language.
Right. So finally, you have to buy a completely separate accounting software like QuickBooks or NetSuite and hire a bookkeeper to try and make sense of what the bank, the invoicing tool, and the credit cards are all doing independently.
It is exhausting to manage.
Yeah.
Every time data has to jump the gap from one silo to another, from the bank to the accounting software, or from the corporate card to the expense management tool, you introduce the risk of human error.
Oh, for sure.
It requires manual exporting of CSV files, manual uploading, and hours of weekly reconciliation.
Here's where it gets really interesting and where the software layer concept of Mercury proves its worth. Mercury is designed to integrate these pieces natively.
Yes.
Their claim in the documentation is that major workflows can be done in 1 to 2 minutes. They have universal search across the entire platform, so you can type in a vendor name and see the wires, the card swipes, and the invoices all at once.
Which is incredibly powerful.
But the feature that really made me stop and reread the notes was the AI bill pay. I want to understand the actual mechanics of this. How does it work beyond the buzzword of AI?
It is a perfect example of shifting the burden of reconciliation from the end of the month to the moment of transaction. Let's look at the legacy workflow first.
Okay, layout.
A freelance contractor emails you a PDF invoice for $4,500. You open the PDF, you log into your legacy bank portal, you open a new water or ACH transfer screen.
And then you manually type in the contractor's business name, their 9-digit routing number, their 12-digit account number, the exact dollar amount, and the invoice number in the memo line.
Right. And you sit there sweating, praying you didn't transpose a single digit in the routing number.
Because if you send $4,500 into the ether, getting it back is a total nightmare.
Exactly. It's high-stress data entry. With Mercury's AI bill pay, the workflow changes entirely. You simply upload or directly forward that contractor's PDF email into the Mercury system.
Just forward the email.
Yep. The platform uses optical character recognition, or OCR, combined with machine learning algorithms to visually scan the document. It identifies the key data points natively. It finds the routing numbers, the account numbers, the vendor name, and the total amount due. It then auto-populates a payment draft.
So it pre-fills the wire transfer form for you.
Yes. And it cross-references its own database. It remembers past recipients. So instead of 10 minutes of stressful, error-prone data entry, you are looking at a pre-filled screen.
That is so much easier.
The software says, we see you want to pay contractor X $4,500. Here are the details we pulled. You act as the verifier, not the data entry clerk. You verify the information, click one button, and the payment is approved and routed.
That is wild. And there's another feature mentioned in the sources that operates on a similar philosophy, receipt auto-matching.
Wow, that's a game changer.
If you've ever tried to manage expenses for a team, chasing down receipts at the end of the month is the absolute bane of your existence. Who spent $42 at a coffee shop in Seattle on Tuesday? It's awful.
It is a universal pain point, and it stems from the separation of the payment vehicle, the card, from the documentation, the receipt.
So with Mercury, the documentation says you just email or upload the receipt, and the system automatically attaches it to the correct card transaction in the general ledger. How does it know which swipe goes with which piece of paper?
It's using that same OCR technology. When you snap a photo of a receipt or forward an Uber receipt via email, the system reads the text.
Right.
It extracts the date, the vendor name, and the exact total. It then scans your recent corporate card ledger. When it finds a matching vendor date and amount, it automatically binds the visual proof of the receipt directly to that specific ledger entry.
And because Mercury integrates directly via API with major accounting software like QuickBooks, Xero, and NetSuite, all of that data, the payment, the vendor, and the attached visual receipt just flows right into the accounting software, cleanly categorized.
Yes, the API integration means the systems communicate in real time. A transaction happens in Mercury, and it is instantly reflected in QuickBooks with the receipt attached.
That is amazing. And hey, if this sounds like an absolute relief to your administrative bottlenecks, the link to sign up and start bypassing that patching headache is right there in the description. Check it out.
It really is a relief.
It really sounds like we're moving from driving a manual transmission car where you have to clutch, shift, and monitor the RPMs of every single system yourself to an automatic where the engine just knows when to shift gears between billing, spending, and accounting.
If we connect this to the bigger picture, we have to look at what this actually saves the business. It is a fundamental shift in philosophy.
Okay, what do you mean?
The legacy philosophy is that banking data is just raw material that you have to manually refine into accounting data.
Oh, I see.
The modern philosophy is that banking data should be accounting data from the moment it is generated. By eliminating the patchwork, you are fundamentally lowering the administrative hours a founder or a finance manager spends per week.
And what is 5 hours of a CEO's time worth to a growing startup? It's invaluable. It's the difference between working in the weeds of the business and working on the strategic growth of the business.
Precisely. You stop being a highly paid data entry clerk and go back to being a strategist.
Right.
You're buying back your own time.
Okay, so these automations are fantastic for the solo founder or the small partnership, but businesses grow, people get hired, and right now, teams are more distributed than ever.
Very true.
You might have a CEO in Austin, Texas, a lead developer in Ohio, and a media buyer in London. How does a digital interface handle a team scattered across multiple time zones? Because historically, giving an employee a physical corporate credit card is a terrifying milestone for a founder.
It is deeply anxiety-inducing. The traditional model is handing over a piece of plastic with a shared $50,000 corporate credit limit and simply hoping the employee uses good judgment.
Right. Please don't buy a boat.
Exactly. It relies entirely on trust rather than systemic controls. That is not a sustainable risk management strategy for a scaling company.
But the alternative is equally bad. The alternative is the CEO acting as a bottleneck, having to personally log in and provide their own card number for every single $50 monthly software subscription.
Or making an employee pay out of pocket for a flight and submit a frustrating expense report to get reimbursed 3 weeks later.
Neither scenario is efficient.
Which is exactly why the concept of instant virtual cards combined with granular team permissions is so revolutionary for distributed teams. It solves both the risk problem and the bottleneck problem simultaneously.
I want you to walk me through how this actually empowers a remote team. Let's use a hypothetical case study.
Okay, let's hear it.
Let's say I run an e-commerce brand. I'm the founder in Austin, and I just hired an ad buyer in London. This ad buyer needs to spend $15,000 a month across Google Ads, Meta Ads, and TikTok.
Very common scenario.
In a legacy system, how does that work, and how does Mercury change it? And again, to you founders listening who are currently sharing their personal credit card via Slack messages, please stop doing that and click the referral link in the description to fix this right now. Seriously, stop doing that. All right, let's look at your London ad buyer. In a traditional setting, you have two bad choices.
Number one.
One, you give them the main physical corporate card. If that card number is stolen in a data breach, your entire company's $50,000 credit line is exposed.
And while the bank investigates the fraud, all your other recurring subscriptions attached to that card, your servers, your email marketing, they might bounce.
Exactly. Total operational halt. The second bad choice is you make them ask you to input the card every time they launch a new ad campaign, which slows down your growth.
So what does the virtual card workflow look like?
With Mercury, the founder logs into the dashboard in Austin, they navigate to the card section, and they instantly spin up a new virtual credit card.
Instantly. There's no waiting for the bank to mail something.
Instantly. The API talks to the card issuing network and generates the active number in milliseconds. It's not physical plastic.
Wow.
It is a unique, generated 16-digit Visa or MasterCard number, complete with its own expiration date and CVV code.
That's crazy fast. The founder names this specific virtual card London Ad Spend. Now, here's the crucial part. They set a hard, unbreakable monthly limit of exactly $15,000.
So it physically cannot spend more than that.
Right. They then assign that specific virtual card to the London employee's user profile within Mercury.
I see the value in virtual cards, but let me push back for a second. If I have a team of 20 people and we have different cards for ad spend, server hosting, travel, and office supplies, isn't managing 50 different virtual cards just creating a different type of administrative nightmare?
How so?
Instead of reconciling receipts, now I'm managing a fleet of digital cards.
That is a very common concern, but it misunderstands how the ledger works. You aren't managing 50 separate statements.
I'm not.
No. All of those virtual cards feed into your one centralized master operating account balance. They were just different digital pipes pulling from the same reservoir. And because of the automations we discussed earlier, it actually reduces admin work.
How does it reduce it?
Because of auto-categorization. When you create the London Ad Spend card, you tell the system every transaction on this specific 16-digit number belongs in the marketing and advertising ledger category.
Oh, wow.
From that moment on, for the rest of the year, every time Google or Meta charges that card, Mercury automatically tags it as marketing, and the API pushes it to Xero or QuickBooks as marketing. No human ever has to manually categorize those expenses again.
That is incredible. So the London employee logs into their portal, they see their $15,000 limit, they get the card details digitally, and they can do their job autonomously.
Exactly.
And if the card gets compromised, say a bad actor gets the number.
The founder clicks one button to freeze or delete that specific London ad spend virtual card. The fraudulent charges are stopped, but your AWS server hosting, which is running on a completely different virtual card, is entirely unaffected.
The blast radius of a compromised card is contained to that single virtual asset. What is happening here psychologically is brilliant. You are turning executive anxiety into employee empowerment. The founder sleeps well at night knowing the absolute maximum exposure on that specific card is capped at $15,000.
And the employee feels empowered because they have the tools to execute their job without begging the CEO for a credit card number. It completely removes the bottleneck of centralized purchasing.
And you just reminded me, if you want to experience that kind of granular control over your team's spending, that link is in the description. Do not forget to use it to get your $250 bonus when you fund the account.
It is a profound shift in how a business scales its operations. You are building financial guardrails out of code, rather than relying on trust and manual oversight.
Okay, so this sounds amazing for a distributed digital team. But since this is entirely digital and heavily automated, it's clearly not meant for every type of business on Earth.
That's true.
Let's talk about the ideal customer profile. Who actually thrives on this architecture and who needs to look elsewhere?
It is vital to recognize that no financial platform is everything to everyone. In the modern fintech landscape, the business model of the company dictates the banking model they require.
Let's start with the winners. The source materials highlight startups very heavily. In fact, it says 1 in 3 U.S. startups choose Mercury. That is massive market penetration. Why are they dominating that specific demographic?
Startups have a very unique financial life cycle. They need extreme speed to open an account when they incorporate. They need software that scales instantly.
Right.
But more importantly, eventually, they need access to specialized capital structures like venture debt. When you are a venture-backed startup that just raised a Series A, you don't have time to wait 3 weeks for a legacy bank committee to approve a simple wire transfer limit increase so you can pay your offshore dev team.
Oh, absolutely not.
You need software that scales seamlessly from your first $50,000 seed check all the way to a Series C round holding tens of millions of dollars. Mercury is built to handle that specific velocity of capital.
The second group that wins big here is e-commerce.
E-commerce is arguably the most complex everyday cash flow model out there. Consider the data flow of a successful Shopify store.
Oh, it's wild.
You have a massive volume of microtransactions coming in constantly from payment gateways like Stripe, PayPal, or Shopify payments. Simultaneously, you have massive, lumpy expenses going out for inventory, warehousing, third-party logistics, shipping labels, and massive daily digital ad spend.
It's a literal fire hose of data, hundreds of transactions a day.
Exactly. If you try to manage a high-volume e-commerce brand on a traditional bank statement that just lists 1,000 generic line items at the end of the month, you will lose your mind trying to calculate your actual daily gross margin.
Yeah, good luck.
A digital-first platform with robust API integrations centralizes all of that tracking. The platform can parse the payouts from Stripe and map them against the ad spend on your virtual cards in real time.
And the third group mentioned as a perfect fit is agencies and consultants.
Because agencies manage multiple clients, they rely heavily on recurring retainer invoices. They also often manage a highly fluid roster of freelance contractors who need reimbursements, or they need to spin up project-specific budgets.
Right, so the AI invoicing tools and the project-specific virtual cards we just discussed are essentially tailor-made for an agency's operational workflow.
Exactly.
So if you fit into that startup bucket, or you run a fast-moving e-commerce brand, or you are managing a digital agency, this platform is speaking your exact language. If that sounds like you, check the link in the description to start your application and grab that $250 bonus.
That's a no-brainer for those models.
But we have to be fair and transparent. Let's talk about the exclusions. Who is this terrible for?
Cash-heavy businesses. It is a fundamental limitation of the platform's architecture.
Because it's digital.
Right. If your business involved taking physical paper money from customers, say a restaurant, a laundromat, or a physical retail store, and you need to deposit that physical cash at the end of the day, a digital fintech platform is not for you.
Because there's no physical branch to walk into with a canvas bag full of $20 bills.
Exactly.
So if I run a local laundromat that deals in quarters and cash, using Mercury would be a nightmare. I'd have nowhere to put my money. But if I run a digital marketing agency operating entirely in wires and ACH transfers, this is my holy grail.
That is exactly the distinction. The local laundromat needs a local community bank with a physical night drop box and a vault. The digital marketing agency needs an API-driven software platform.
Are there any other exclusions?
Furthermore, the documentation lists strictly prohibited industries. Due to the rigorous compliance frameworks of their partner banks who hold the federal charters, Mercury cannot serve money services, businesses, adult entertainment, cannabis-related businesses, internet gambling, or trusts.
Okay, that makes total sense. The compliance costs for those industries are astronomical, and a software layer isn't equipped to do field audits of a cannabis dispensary.
Mhm.
Now, let's pivot and talk about geography. We've talked about digital businesses, which by their very nature are borderless. An e-commerce brand can sell to a customer in Ohio, source materials from Vietnam, and have customer service in the Philippines.
Yes.
So what if the founder of this US-based company isn't actually physically located in the United States?
This is one of the most compelling aspects of their offering, but also one of the most heavily scrutinized by regulators. Mercury does allow applications from international founders who are not U.S. citizens and are not U.S. residents.
That is a massive deal. Gaining access to the U.S. banking infrastructure, the most robust financial system in the world from abroad, is notoriously difficult. But I'm looking at the rules in our source stack, and they are incredibly strict.
Yeah.
It is absolutely not a free-for-all.
Not at all, nor should it be. This raises a vital point about global financial compliance. The U.S. financial system is heavily guarded by KYC Know Your Customer and AML, which stands for Anti-Money Laundering Regulations. This stems largely from the Patriot Act and subsequent financial regulations designed to prevent terrorist financing and global money laundering. Allowing foreign nationals access to U.S. banking infrastructure requires immense, highly technical due diligence.
Let's walk through these strict requirements because I want any international founders listening to know exactly what they're up against. First, the company must be legally formed and registered in the U.S. or U.S. territory. You can't just be a German GmbH or a UK Ltd wanting a U.S. account. You have to establish a U.S. entity, like a Delaware or Wyoming LLC.
Correct. You must exist within the U.S. legal framework. Second, you must have existing or planned U.S. operations.
What does that look like?
There has to be a legitimate, documentable business reason for the entity to exist in the U.S. market. Perhaps you are selling to U.S. customers via an Amazon storefront or raising capital from U.S. venture funds.
Now, here is the critical one that I know trips people up, and the documentation puts this in bold red letters. You must provide a valid principal place of business address. And the notes heavily emphasize this. A registered agent address, a P.O. box, or a UPS store mailbox is strictly prohibited for this requirement.
This is the #1 area where international founders fail compliance. When you form a U.S. LLC from overseas, you are legally required to hire a registered agent, a company in the state of incorporation whose only job is to accept official legal mail and lawsuits on your behalf. But a registered agent's office is not your company's principal place of business.
Right, because the registered agent's address is usually just a tiny office in Delaware shared by 10,000 other LLCs.
Exactly. The banking regulators want to know where the actual day-to-day business operations are being managed from. They do not want shell companies hiding behind P.O. boxes. You must provide a legitimate operational address to satisfy the KYC requirements.
So what do you use?
If you are operating the business from an office in London or an apartment in Berlin, that is the address you must provide.
That is fascinating. The U.S. banking system is basically saying, we welcome your global business, but you cannot be a ghost. We need to know exactly where you sleep at night.
Transparency is non-negotiable in global finance, which is why the remaining requirements mandate official, state-stamped formation documents, an IRS-issued EIN employer identification number, which proves you are recognized by the tax authority, a valid government ID, and the identification of any beneficial owners holding 25% or more of the company.
How does a U.S. fintech even verify a government ID from a founder in Brazil or Japan?
They use highly advanced third-party compliance APIs. When the founder uploads their passport, the system uses biometric scanning to match their live selfie to the passport photo.
Wow.
Yeah, it checks the document's security features against a global database of valid IDs and cross-references the founder's name against global sanctions lists, Interpol databases, and politically exposed person lists.
It's incredible technology. And speaking of the sanctions list, You also must not be located in a prohibited country or region, and that list is constantly updated by the Office of Foreign Assets Control, or OFAC, based on international sanctions.
Correct. So having a U.S. LLC document does not magically grant you a bank account. You still have to pass rigorous fintech compliance.
But if you are an international founder and you run a legitimate business and you meet these criteria, you have a massive opportunity here to plug directly into the U.S. economy. And yes, to the international founders listening right now, you can apply today using the link in the description to secure your $250 bonus, provided you meet these strict compliance rules. It's step one of your global expansion.
It is a rigorous, demanding process. But for an international founder, securing a stable, feature-rich U.S. operating account is a massive competitive advantage.
Okay, let's talk about the cost of all this software. Let's talk about scaling up. Assuming you get approved whether you are a solo founder in Texas or an e-commerce brand operating out of Tokyo, what is this going to cost you as your business scales from zero to a massive enterprise? Because we started out saying traditional banks nickel and dime you with fees. Mercury has a distinct tiered structure.
Yes, and understanding how a business logically transitions between these tiers is key to understanding their entire value proposition. They use a SaaS pricing model, software as a service, which is radically different from traditional bank fee structures.
Let's start with the baseline, which is almost shocking. The free account. It's $0 a month.
And this is where the disruption of the traditional banking model is most apparent. The free tier has no required monthly maintenance fees. It has no minimum balance requirements to avoid those fees, and crucially, it has no overdraft fees.
But wait, the source material says you get free USD wires on the free tier, both incoming and outgoing. Traditional banks charge what, $15 to receive a wire and maybe $30 or $40 to send a domestic Fed wire?
Often more, especially for outgoing wires or international wires. The FedWire network costs money to use, but Mercury subsidizes that cost. Eliminating that $30 fee alone can save a high-transaction business, like an agency paying 20 different contractors every week, thousands of dollars a year.
That's a huge saving.
You also get 1.5% cash back on your credit card spend and access to their treasury product if you hit a $250,000 balance, which allows you to seamlessly sweep your idle cash into money market funds to earn yield. For the vast majority of early-stage startups and solo consultants, the free tier is incredibly robust, and it may be all they ever need.
But then we step up to the first paid tier, Mercury Plus. This costs $29.90 a month. If the free tier is so good, what exactly are we paying $30 a month for?
You are paying for advanced workflow efficiency and programmatic control. The Plus tier adds features that specifically save administrative time. It unlocks recurring invoices, the ability to invoice clients with an ACH debit pull, which costs $1 per transaction on this tier, and crucially, it unlocks the invoicing API, allowing your custom software to programmatically create up to 500 invoices per month. It also bundles in unlimited 1099 tax filings for your contractors, discounts on legal services, and 6 months free of zero accounting software.
Here's where it gets really interesting to me. As you said, this is basically SaaS pricing. You aren't being charged $30 a month as a penalty for holding your money in a vault. You're paying a subscription fee for advanced software features like API calls and bulk automated tax filings.
Exactly. Think about how a business transitions operationally. A solo graphic design consultant who sends 3 PDF invoices a month is perfectly fine on the free tier. They don't need an API. But imagine an OS agency that manages 400 client accounts. If they want their custom dashboard to automatically generate and send 400 invoices on the first of the month without a human touching a keyboard, they need the invoicing API. They will gladly pay $29.90 a month for the Plus tier because that API automation saves them 20 hours of manual data entry.
The return on investment for that $30 subscription is immediate and obvious.
Totally.
And if your business is at that stage where automation is worth paying for, you know where to start. The $250 bonus link in the description is your entry point. Whether you start on free or plus, seriously, check it out. But what about the top tier, Mercury Pro? This jumps significantly up to $299 a month. That is a serious enterprise-level software subscription.
Mercury Pro is designed for mature businesses with highly complex, high-volume operations. The defining feature at this level isn't just software. It is the addition of a dedicated relationship manager.
A real person.
Yes. When your company is moving tens of millions of dollars, navigating complex international wires, or preparing for an acquisition, having a direct human point of contact, A real person who knows your business architecture is critical.
Okay, so it's massive software scale combined with bespoke human support.
Yes. But it also scales the software economics for high-volume users. On the Pro tier, those ACH debit invoices we mentioned, they become totally free, $0 per transaction.
Oh, wow.
The invoicing API becomes completely unlimited, and it unlocks advanced categorizations for NetSuite, which is a massive enterprise-grade ERP and accounting software.
So it's just a math equation at that point. If your agency is processing 3,000 ACH debit payments a month from your clients, paying $1 a piece on the Plus tier would cost you $3,000 in fees.
Exactly.
By upgrading to Pro for $299 a month, all of those transaction fees drop to zero. The $299 subscription pays for itself 10 times over.
Precisely. The fee structure is designed elegantly. You only pay for advanced software infrastructure when your operational volume demands it. And when your volume demands it, the flat subscription fee actually saves you money on per-transaction costs.
It is a totally different way to think about banking costs. And I'll say it one last time before we begin to wrap up our deep dive. Whether you need the free tier to bootstrap your very first e-commerce LLC, or you are migrating an established enterprise onto the Pro tier to save on ACH fees, that $250 bonus link in the description is where you need to begin your journey. It is step one.
It is the most logical starting point to capitalize a new, highly efficient financial ecosystem for your business.
So what does this all mean? Let's take a step back and recap the journey we've taken over the last hour. We started by dismantling the concept of the physical banking vault. We learned the precise, automated steps to secure a $250 bonus by bringing $10,000 in operational working capital to a new platform.
We explored the deep technology like OCR and REST APIs that powers AI bill pay and receipt matching, replacing a chaotic patchwork of legacy apps.
We detailed the psychological and operational shifts required to empower remote distributed teams using the granular control of instant virtual cards. We clarified the rigorous KYC compliance and strict U.S. address rules that allow international founders to play in this powerful sandbox.
And finally, we broke down a SaaS-style pricing tier that scales seamlessly from a solo founder to a complex enterprise processing thousands of monthly transactions.
It has been a comprehensive look at how financial technology is fundamentally altering the day-to-day reality of business operations. We are witnessing a macroeconomic shift away from banking as a passive, heavily guarded storage facility and moving toward banking as an active, programmatic participant in your company's operational efficiency.
Well said.
To everyone listening, if your current bank feels more like a roadblock than an engine, if you are spending your weekends categorizing receipts or waiting days for transfers to clear, I highly encourage you to click the referral link in the description. Claim that $250 offer, move over a slice of your operational capital, and see what a modern, software-first financial operating system can actually do for the velocity of your business.
I think we've covered the mechanics and the technology thoroughly today, but before we go, I want to leave the listener with a broader, perhaps slightly provocative thought about the future.
Oh, all right. What is it?
We've established that your financial platform is now essentially a highly intelligent software company. It is a platform that can actively read your invoices, natively categorize your accounting ledgers, issue tightly controlled virtual cards to employees in London, and route massive amounts of money programmatically through APIs.
Right. It does all that today.
If it can do all of that today, how long until the platform starts making strategic operational decisions for you? Will the bank of the near future evolve into an automated AI-driven CFO? Imagine a dashboard that analyzes your daily cash burn rate against your historical revenue and proactively suggests specific budget cuts on your marketing virtual cards, or automatically shifts your idle capital into higher-yield treasury strategies all before you even log in and ask it to.
That is a wild, almost sci-fi thing to think about. The Vault isn't just an operating system anymore. It is rapidly becoming a strategic partner. It's moving from executing commands to suggesting strategy. That is definitely something for all of you to ponder as you build your businesses and choose your infrastructure. Thank you so much for joining us on this deep dive into the future of finance. Go check out that link in the description, get your bonus, and we'll catch you on the next one.